Hello everyone, my name is Chris Granary. I'm a client advisor with Eos Property Group. I'd like to talk to you a little bit about our Armchair Developer concept, how it works and how it can benefit investors. For the last 10 years or so, we've been working carefully with investors trying to find for them the highest quality properties we possibly can in terms of long-term growth. So we've worked with builders and developers looking at properties, trying to push the price down to provide good investments for our clients. In that process, we spent quite a bit of time working with developers, as you can imagine, and it dawned on us that the guys making the real profit were often the developers. In fact, if the developers couldn't show a 20% profit on the deal, then often the banks wouldn't be interested in lending to them. And so it struck us that why is it the developers making the profits on these deals? Why can't our investors make the developers profit? And so with that concept in mind, we developed up this armchair developer idea. And the aim was to assist our investors to make that developer's profit. And so for the last 12 months, we've been looking at that concept, developing up and working it through, with the aims to provide to our investors somewhere between 20 to 35% capital gain on the property, to produce a return on the initial investment of at least 100%. That means the money they initially put in, they get that back at least 100 times over. To have a high rent return, certainly far proportionally higher than a normal purchase, and to complete the entire project within 12 months. So that was our aim, to allow our investors to make the developers profit. And over the last 12 months, we've been working on 5 developments. And I just want to look through the maths on those to give you a feeling for what the overall results are likely to be. If you just focus on that top one in South Hedland, you'll see the purchase price, the total cost to the investor was $365,000. We have valuations at $590,000. Therefore, the estimated profit is $225,000. The rent return, we've been told by both the valuers and the local agents, is $1,300 per week, about $67,000 per year. And of course, that'll give you a yield of around 18.5%. And Carafa and South Hedland, you can see the numbers there. You will notice that the purchase prices have crept up, and that's because land values have continued to increase, as have construction costs, and as a consequence the total cost to the individual investor have crept up slightly. You'll still notice, however, that the capital gains are still significant, and the yields are around that 15, 16, 17%. So quite exciting numbers. Now, if that's the incentive, let me talk a little bit about the process itself, because it's not like buying a normal investment property. There's a little bit more hands-on involvement, and you need a deeper understanding of the development process so that you can be in tune with what's going on. As it says there, it's really not for the faint-hearted. It does require commitment and confidence, and it requires a group of like-minded investors that pool their resources together. It's a fairly sophisticated group, and that's what we produce. So essentially, if we have a site we believe we can put 4 units on, for example, then we will find 4 investors for the project. Those 4 investors form a joint venture, and that becomes an entity in itself. And the joint venture then employs a development manager. Now his job, his profession in fact, is to oversee and manage completely the development, from the sourcing of the land right through to the construction finance, to following the build process right through, tackling all the problems, having resolved in the best interests of the joint venture, to finally complete the project for the benefit of the joint venturers. And then at the end, the joint venture then dissolves, and each of the 4 investors takes over personal ownership of the unit. And as a consequence, they have then purchased a unit and made a significant developer's profit on the deal. So that's how the concept works. A group's formed, they employ professionals to do the job on their behalf, and in the end they reap the rewards that's normally attributed to a developer. And EOS's job is to coordinate, liaise, and bind the whole thing together to make sure everything runs smoothly and operates to the benefit of the investors. Now I'd like to talk a little bit more in detail about how the process works so you get a better understanding of the concept. And so perhaps the best way to do that is to look at their last project, which was in Headage Street in South Headland, and that may help put some things in line for you. The first thing we do is to conduct a feasibility study on the site itself. You have to know what the numbers are before you even begin. So we work out what the value of the property is going to be upon completion. We work out what the costs are to purchase the land and do the construction, subtract the costs from the overall value of the property, and to make sure that there's a good profit in there for our developers. Once we're confident that there is a developer's profit in the deal, we then go and seek the investors. Now we've got 8 investors. In fact, there was 10 required for Headage Street, but I put 8 in there because I got sick of making these little people up. So bear with me if you would. 8 investors. They all contribute to the joint venture account. So joint venture is established, it has a bank account, and in this case, each of the investors contributes $135,000. This covers the purchase of the land and some of the initial developer's costs. So because the joint venture now has funds, it's able to purchase the land outright. That means there's no debt on the land, and that's crucial. So each of the investors has had to find the 135 from sources outside the development. They've had to borrow against their own home or from savings that they've got or cash in their bank or perhaps equity in other investments. They each contribute so that the joint venture can buy the land and there's therefore no debt. As a consequence, the joint venture can then seek, through the development manager and finance brokers, funding for the actual construction. So the finance broker will go to a bank and say, here we have a block of land with no debt on it, lend us sufficient funds for the construction. And the development manager and the finance broker work together to source those funds to build the buildings. Now at that stage, on completion of the buildings, there is then 8 or 10 buildings on one block of land. The loan-to-value ratios are around about 70%, so we keep it fairly low so the banks are relatively happy. Now we've got a completed site, but it's still only one title. Now the title is owned by the joint venture or by the joint venture participants, if you like. We now need to separate it out so everyone can take individual ownership. Now at this stage, each of the investors has only contributed $135,000. The funds required for the construction have been borrowed by the joint venture. So it's this stage where the individual joint venture participants now want to take personal ownership. So we have all the dwellings on one site, we partition it off, so each of the 8 investors then takes ownership. So in order to do so, they refinance their construction loan, repay back the joint venture the funds for the construction, and take over ownership of the unit. And they can find the 274 in this case by taking out a loan against the investment property. With the original 135, they had to find that from external sources. But now as they take ownership of this unit, they can borrow the 274 against the property itself. They take over ownership, the joint venture dissolves, and then they have complete control over their unit. As a consequence, let's do the maths. Before we began, we knew that the units were valued at $590,000. The original cost was $135,000. The construction cost was $274,000. The total cost to the investor has been $409,000. The profit, therefore, is $181,000 in capital gain, and the rent return is at $67,600 per year. So you can see this concept of Armchair Developer can produce some fairly significant returns, both in terms of capital gain and in terms of yield. And that's what the big attraction, of course, is to this concept. Yes, it's slightly more complex. Yes, there's a few more risks involved than the normal buy off the plan or buy through a real estate agent, but you can agree, I think, that the returns are quite significant. What it does do, this idea, which turns typical investing a little bit on its head, is therefore allows us a range of options that we might not have considered previously. So for example, if you purchase one of these units, you may sell on completion, take the profit and invest in another one. Whereas perhaps with the first one you've had to borrow the initial funds, because you've now produced a profit on this first one, maybe you can use the cash into the second one rather than have to borrow money. And then do it again, and then do it again, and then do it again. Continue doing so, just taking a profit upon the completion of each unit. Alternatively, don't sell. Hold the unit, enjoy the cash flow. We estimate if you've borrowed all the funds for the property, you're still about $30,000 a year cash flow positive. So that's a scenario as well. Alternatively, hold the property, use the extra cash flow to pay down the principals on the loan. So within about 5 to 7 years, you'll own the property outright. So you now have no debt on a property in Headland or wherever it's going to be, but you're earning a cash flow of $60,000 or $70,000 a year. The cash flow will maybe help support your current property portfolio. I know many investors have got long-term properties, but there's often a shortfall on those, and that can be quite painful. With a positively geared property like this one, the extra cash can perhaps go towards meeting the shortfall on the long-term property portfolio. And of course, the obvious one is to use the cash to help fund a retirement. Now, we've looked very briefly at the concept and we've looked at properties at Port Hedland and Karratha, and certainly they are particularly appealing because of their high capital growth and the high rent returns. But it's not only these areas that we're looking at. You also may want to consider some properties in Perth where this developer's concept works equally as well. Now, to find out more about this and to get some more details, don't hesitate to ring us or email us or jump on the web and have a look at this developer concept. I'm sure you'll find it very interesting, if not compelling. Thank you for listening, folks. I hope to talk to you soon.